Miss tengah bercakap kan, but then kita orang tak dengar suara Miss.
Sekarang dengar? You guys hear me now?
Yes.
Okay, thank you. Kalau tak, I dah shot sendiri dah dari tadi. Okay. So, hi guys. Okay, sorry for the technical difficulty. It's funny, I have two headphones. And then like dua-dua decided to die on me. So I had to take both of my headphones. So I think satu walaupun I dah take pun, it's like still rosak. So I'm trying out the other one. Thankfully the other one works. Okay. So you guys can see my screen, right? Okay. So from the module, the sprint module, okay, kan we've completed these two questions yesterday, which is Orlando, and the first question is on Darjeeling. Okay, so today I want to cover these other two questions, but today I kind of want to like, I hope that you guys can participate in this together with me because it is something that requires a lot of practice. So once you guys have actually practiced a lot of questions, then you guys will kind of see and get a hang of it more, okay? So I hope that you guys have prepared your answer plan. Okay, as you guys can see here, I've already created like just a simple answer plan, basically like just summarizing whatever audit risk that I have found from this scenario here. Okay, so I hope that you guys have covered that. Like I said, today I'm trying to like focus more on the question instead of like really going through the scenario again. I hope that you guys can go through it yourself at home and then we terus just discuss on the answer plan. All right, is that okay? So the first is basically on the new client. Hardcore is basically auditing a new client, which is, oh no, Hardcore is the new client. We are Morphco. Okay, Hardcore is a new client. Okay, in this case, this is something that's very repetitive. Okay, so whenever there is a risk of a new client, the explanation will be the same thing over and over and over again. So we can talk about how, as a new client, we may not have sufficient understanding of the entity. Okay, as Hardcore is a new client, Morphco may not have sufficient understanding of Hardcore's business and the risks of material misstatements. Okay, so what is the implication? There is an increase in detection risk. Okay, another thing that we can say is, as we did not actually do the audit in the previous year, there is less assurance over their opening balances. Who did not audit Hardcore in the prior year? Okay, so for the auditor's response, can somebody try? Okay, this is something that's very repetitive, so it's kind of like a bonus mark. What do you guys think will the auditor's response be? If this is a new client, what can we do? Anyone? Okay, so Alia said allocate senior audit team. Mahzan said require experienced team. Yes, this is correct. Basically, we have to allocate a more suitably experienced audit team, okay, and basically allocate more time for the audit team to obtain understanding on Hardcore's business and the risk of material misstatement. And another thing that we can say is, like just now I've explained how, as we did not do the audit for the previous year, then basically there's less assurance over their opening balances. Okay, so we want to emphasize on these opening balances. There may be a misstatement in these opening balances. Okay, so what we're going to say is we are basically going to do detailed testing on the opening balances. Okay, that's basically going to be our answer. Okay, the next point is basically directors paid a bonus based on a percentage of profit before tax. Okay, do you guys, what is the right, is this proper for us to pay directors based on a percentage of profit over tax, a profit before tax? Is this appropriate? Okay, so yeah, this is not appropriate and this can actually cause ethical issues juga to arise. Okay, hold on, guys. Okay, so let's talk about it. Basically, what is the explanation? Okay, so the directors may be motivated to manipulate the financial statements, or specifically the profit before tax, by overstating the revenue and understating cost in order to obtain bonuses. Okay. Yeah, Najwa said risk of manipulating the profit, and Ayn said should be based on their performance. That's correct. It should be based on their performance and maybe the time. Okay, based on the time. All right. So what is the impact here, guys? There is basically an increased risk of financial statements containing material misstatement. Okay. So what is the auditor's response here? Okay, I've actually highlighted this a lot of times. If there is an indicator that a fraud or manipulation might happen, what is the auditor's response?
Increase professional skepticism.
Yeah, that's correct. Kita boleh buka audio tu. Okay, yes, professional skepticism. Okay, so basically, first things first, auditor to maintain professional skepticism and remain alert to potential manipulation of PBT by directors. Okay, another thing that we can do is audit team to assign more experienced audit team to the audit, basically focusing on areas with significant judgment and estimates. Okay, because these are areas where directors can actually manipulate, especially for like, for example, provisions. Okay, so these are areas that are more prone to manipulation. Okay, so on this deposit, okay, like I said, they kind of like to macam include on IFRS 15. They macam in every year, they will usually have one audit risk relating to IFRS 15. So every time we see an IFRS 15 question, I kind of want to just explain to you guys, so you guys understand the standard. So even if they change the audit risk, it will not go too far. Okay, wait, let me just share my screen. Okay, so this is IFRS 15. Let me just share first. So do you guys still recall your IFRS 15, or is it like dah lama tinggal and then we don't really remember anymore, right? In your FR, I think IFRS 15 is relatively still simple, but when you masuk SPR, IFRS 15 gets very like complicated juga lah, okay? So I want to kind of like brief you guys on the revenue recognition. Okay, I know that this class is mostly on the exam techniques, but on like the harder standards, I want to kind of explain it juga in case any of you guys are not sure. Okay, so this is basically on the revenue recognition. If you guys still remember, then in accordance to IFRS 15, basically we will only recognize revenue when the performance obligation is satisfied. Okay, what does that mean? Is basically when the asset has been, when customer obtains control over the asset. Okay, only then the PO will be satisfied. For example, when let's say if we were to build a building, okay, the construction of the building will take 5 years. Let's just say, so the deposit that we took in the first year from this customer, let's say this customer wants to purchase this building, they have to put in a deposit of 10%. So this deposit, how will you guys account for it? Can you guys just write in the chat? How do you guys think we will recognize this deposit? Okay. How will we recognize this deposit when we receive it in the first year? Anyone want to try? Okay, so basically, okay, let me see. Okay, recognize as deferred income. Yeah, that's correct. Okay, deferred income or contract liability. Basically, that's where we have to think about when is the PO satisfied juga. In my example just now, basically the building construction only completes after 5 years. Okay, so only once the construction of the building is completed after the 5 years, then baru the PO is satisfied. And so only then after the 5 years, baru we can recognize the deposit as a revenue. So this is what we call as a PO satisfied at a point in time. Okay, because as of right now, day one, when the deposit is transferred to us, basically the PO has not been satisfied yet. So we cannot recognize that deposit as part of our revenue, okay, only until the control has been transferred to the buyer. Basically, once the building has been completed and we've transferred control over this building to the buyer, only then we can recognize it as a revenue. Okay, so basically, like you guys said just now, okay, we will recognize a deferred income for this deposit or a contract liability. Okay, and then we will debit cash for the deposit. Okay, so after 5 years, when the building is completed and the control has been transferred, then we will basically reverse out this deferred income, contract liability, and we will finally recognize the revenue. Okay, so even in this example, in this question here, it is a PO satisfied at a point in time. Okay, for a PO satisfied for a point over time is divided into two scenarios. Okay, if we can basically measure the cost reliably, then we will basically recognize the revenue based on the completed progress of the performance obligation. What does that mean is, for example, if the building is 80% complete, then maybe we can recognize 80% of the total cost as of the revenue too. Okay, kalau if the cost cannot be measured reliably, then we will only recognize revenue up to the extent of the cost incurred. Okay, so in our case right now, it is a PO satisfied at a point in time. Okay, going back to our question. So basically, we have to make sure that the company is accounting for this correctly or not. Okay, we have to ask them, are they accounting for this correctly or not? Okay, in this case, there is a 25% deposit. Okay, so as control over playground is transferred over time, the revenue should be recognized. As control over playground is transferred at a point in time, the revenue should be recognized at a point in time. Okay, so what does this mean is, as per IFRS 15, the deposit should not be recognized as a revenue immediately, and instead should be recognized as a contract liability until the control over playground has been transferred to the customer. Okay, actually, even if we want to omit this point here, I think it should be okay, as long as we immediately talk about this. Okay, so another issue that I feel like that could possibly go wrong. Okay, how will you explain it usually? Okay, sometimes students will do this. Okay, as per IFRS 15. Okay, maybe what the students will usually do is we will just explain the requirement of the standard. Okay, we will just generally explain the requirement of the standard, and then baru we go into the fact yang the deposit should not be recognized as a revenue. Okay, this if you just explain on the requirement of the standard without applying it to the scenario, you will basically not get marks, and at the same time you're actually wasting your time, because that point, even though some answers pass here, if you guys notice, they actually do that. They will basically write the general requirement of the standard, and then baru they will apply to the scenario. Isn't that correct? However, in reality, we are humans and we are always lacking of time, so I would not recommend this. Okay, immediately try to apply to the scenario. Okay. So what is the implication is there is a risk that revenue may be overstated and contract liability is understated if deposits were wrongly included as revenue. So even if you want to say deferred income point is okay, there's just two different terms. Okay, so what can we do is maybe obtain a copy of the contract with customers to review the terms of agreement and understand the performance obligations. We have to discuss this with management, the criteria for determining whether the PO has been satisfied, and ensure the 25% deposit is correctly accounted for in accordance with IFRS 15. Okay, so let's just say if you are not sure what is the accounting standard, then just say with the relevant accounting standards. Okay, if you want to stay safe, okay, don't just hentam if you are not sure of the accounting standard. Just say the deposit is correctly accounted for in accordance with the relevant accounting standards. Okay, so the next point here, the audit team to attend only 5 of the WIP counts. Okay, basically, what can we say? Okay, I want to say in a more simple way here. Okay, audit team, okay, basically the valuation of work in progress. Okay, if you guys still remember, how do we calculate work in progress? Can you guys tell me, how do we calculate work in progress? Basically, it is the direct cost plus labor cost plus overhead, production overhead, and then we will times with the stage of completion. Okay, so how do they actually determine this stage of completion, right? It's a very highly subjective area. Okay, so the valuation of WIP is a highly judgmental area and it's a material balance. Okay, if you guys notice here, the amount is 7.6 million. Even if I were to not calculate that, I compare with the profit before tax pun, it is clearly a material amount. Alright, you guys can calculate specifically lah how much is it if you want to calculate kan. 7.6 let's say over 12.2. So nanti you guys boleh calculate. Okay, but this is a clearly material balance lah. Okay, so implication dia is basically an increased detection risk on the quantities and the valuation of WIP. Thus, the inventory may be overstated. Inventory may be overvalued or overstated. Okay, so this is also a typical thing that we can say. Auditor to assess. Okay, we might be able to say like allocate more team members to attend all the WIP counts, but this may not be practical. Okay, it may be that we really do not have sufficient resources, so this point is not very strong lah. Okay, so we basically have to pick which ones we're going to go for and what will we do at the points at the inventory counts that we are not able to attend. Okay, we have to assess which inventory counts the team will attend. Most likely the inventory sites with the highest or most material WIP balance, or which are assessed as having higher risk of misstatement. Okay, so now let's talk about the inventory counts that are not attended. So the audit team will need to obtain and review documentation relating to controls surrounding the inventory counts, and then we will have to note on any exceptions noted during the inventory count and discuss with management any issues which arose. Okay, so I think that the other ones I want to kind of discuss with you guys, and I hope that you guys can attempt pula. Okay, because I think that by today we should get a hang of it, right? So yesterday I think that we didn't really focus on the auditor's approach that much, right? But today I want to see you guys try to attempt not just answering the audit risk and explanation, but also with the auditor's approach. Okay, try your best, okay guys? But let's just go through it a little bit. Okay, so the warranty provision reduced from 6% to 2% of revenue despite no significant differences in construction techniques or level of claims in the year. Okay, I want to go to this point. It's here. Okay. Hardcore offers its customer a warranty at no cost, which guarantees that the playgrounds will function as expected for a period of 3 years. Okay, so can I ask you guys, is this what accounting standard is this accounted for? This warranty. Okay, this is also something I want to explain. Okay, at this point, what accounting standard is it accounted under? Okay, IAS 37, that's correct. Okay. However, whenever there is a warranty, I want your thought process to be not like terus IAS 37. It actually depends. Okay, so let me just share again. I want to explain a little bit on this before you go into attempting the question. In case lah, guys. Okay, so next is basically on warranty. Okay, the first thing you have to ask, if this warranty, can it be purchased separately or cannot be purchased separately? Okay, what does it mean? Okay, warranty, an example of warranty that can be purchased separately is, for example, if you guys buy an Apple pen. Okay, so example Apple pen. Okay, padahal ni stylus je. But basically, if you buy an Apple product or whatever product Apple pen pun, basically you can purchase a special warranty at the site. They come with a normal warranty, but they akan usually offer you guys a special warranty that you pay extra for, maybe macam 400 extra for this warranty, yang basically if your item macam like rosak or basically you drop your phone or anything within the next 2 years and it is damaged, you can basically return it to them and they will basically return your phone to a new one. Okay, so this is a special warranty that is up to the customer if you want to opt for this extra warranty. So this is an example of how a warranty can be purchased separately. Okay, and so right now this warranty is a distinct service. And so it should be recognized under IFRS 15 as a separate performance obligation. Okay, what does that mean? Is basically we will account for the item, for example, the Apple pen, separately with the warranty. Okay, However, if the warranty cannot be purchased separately, that means it comes as a set. Okay, so even within the question just now, it comes as a set. Okay, so when it comes as a set, it is not a distinct service. This is basically considered a single PO, and we have to account for it under IFRS, IAS 37. So we will debit expenses and credit provision on this. Okay, so going back to the question, basically this is an area of high uncertainty juga, an area which is judgmental, which they can also manipulate. Okay, we basically have to, and thing that you guys can talk about within the auditor's approach, if you want to question, okay, how come they have reduced this warranty provision even though there is no significant difference in construction techniques or the level of claims. Okay, so basically that is for the auditor's approach. Okay, and then here I want you guys to kind of talk about, for the explanation, talk about what IAS 37 requires us to do, immediately apply it to this scenario. Okay, and next is basically on the recognition of the research expenditure. So this is something we saw a few times yesterday, right guys? So you guys are probably a pro at this already. Okay, so I want to give you guys a kind of like heads up on the auditor's approach. Whenever the audit risk is on determining whether the expenditure meets the recognition criteria or capitalization criteria, or we're talking about the nature of this expenditure, the auditor's approach will be, we want to obtain the breakdown of the related expenditure, basically for us to, and then whenever you guys want to say obtain the breakdown of this expenditure, you have to explain the purpose. Maybe we want to check whether this expenditure, does it meet the capitalization criteria? Does it meet the recognition criteria under IAS 16? Okay, we want to assess the nature of it. Okay, so this is basically a tip for whenever you guys find audit risk questions where we are assessing whether they meet the criteria or not. Okay, whatever it is, you can say obtain the breakdown of this expenditure to assess whether they meet the criteria or not. Okay, moving on to the next one. Okay, the company paid 1 million in advance to secure the machinery, but due to supplier problem, the delivery is delayed and is now scheduled to be delivered in October. Okay, so right now, our financial year end is 30th September. And basically, the arrival of this machinery is after the year end. So basically, as at year end, whenever there is a machinery, when do we basically recognize it? Okay, when do we recognize this acquisition of this machinery? Is it when we pay for the machinery? Okay, let me just say, is it when we pay for the machinery, or when we receive the machinery, or when we receive the invoice? So what do you guys think? Is it A, B, or C? Okay, so the answer is B. Yeah, correct, Najwa. When we receive the machinery, only then we will basically recognize it. So as at the year end, this should not be recognized as our PPE. Okay, this should be recognized as what, guys? Right now, there's a payment in advance. So what is the correct treatment of this machinery? Okay, anything you guys want to suggest? How can we correctly account for this as at the year end? Okay, so yeah, Mimi cakap prepayment. Yeah, we should basically account for it as a prepayment at the year end because the machinery has not arrived yet. We will only debit PPE when the machinery has arrived in October, which is after the year end. Okay, for now, we will recognize it as a prepayment. Okay, so rights issue, the same concept, right? As yesterday, what can we talk about, guys? We can talk about the split between OSC and SP. We can talk about the issue, maybe they are inadequate disclosure. What else can we talk about? What can we talk about here, guys? Yeah, I think that's pretty much it. I think that is the main thing that you guys can say, the split and inadequate disclosure. Next is on the payroll function is outsourced to an external service organization. Okay, so maybe we can do this point together. The other points I want you guys to try to attempt yourself. Okay, for the payroll function being outsourced to an external service organization, the issue is that basically we may not be able to obtain sufficient audit evidence. Okay, so let's explain it together. It may be difficult to obtain SAE. Okay, so I usually just type SAE, sufficient appropriate audit evidence. Okay, to confirm. In your final exam, you're not supposed to use these kind of short forms, okay? This is just for practice purposes. Confirm the completeness and accuracy of controls over the payroll cycle and the liabilities at the year end. especially because this is being outsourced to a separate service organization. Okay, whenever there is another party involved, that actually requires more work on our side too, because we might have to contact this service organization. Okay, and we want to know whether this service organization, do they have sufficient controls over this payroll function or not. Okay, so basically when it is more difficult to obtain SAE, what is the implication, guys? What is the implication when it is difficult to obtain SAE? Okay, so Mimi cakap detection risk is increased. Yes, that's correct. There's an increased detection risk on the payroll and liabilities. So if any errors occurred, this could result in wages and salaries expenses and accruals being misstated. Okay, again, remember, make sure to highlight which specific account is being affected. Okay, so basically, whenever there is an external service organization, one thing that we can ask them for is any related reports. Okay, any related reports. So consideration should be given to contacting the auditor of the service organization. Okay, the service organization will basically have their own service auditor. This is the term for it. Okay, to confirm, again, we have to talk about the purpose. We cannot just say we want to contact them. We want to basically explain why are we doing this. To confirm the level of controls in place. So what can we ask for is a type 1 or type 2 report could be requested. Okay, so this is just for your own knowledge lah, okay? Type 1 is basically a report of what controls that they have in place. Type 2 basically is kind of like how the organization actually monitors and operates these controls, okay? So I think even if you just check out like this, type 1 or type 2 report could be requested is sufficient enough. Another thing is we can maybe discuss with management any changes to the extent of records maintained at hardcore since the prior year audit and any monitoring of controls which has been undertaken by management over the payroll. Okay? And basically this is the last point here, okay? On the local legislation requires more extensive disclosure. However, directors do not intend to provide additional information. Okay? In this case, basically, when the local legislation overrides the IFRS, basically we have to follow the local legislation. Okay, so if we don't do this, basically there will be insufficient disclosure, and then this can actually cause the company to be liable to pay penalties. Okay, so this is what you guys can explain a little bit, and for the approach, maybe you can just discuss with management on what are the requirements of the local legislation. Okay, so can you guys try to attempt these other points here? I think we've tried to complete the other ones together. Okay, so can you guys do the warranty provision? That's the first point. Okay, let me just highlight it. Second is basically on the delivery of the machine. Next is the rights issue. Okay, we did this yesterday, right? So hopefully you guys can come up with not only the explanation, but the auditor's approach. 1, 2, 3, 4. Okay, can we do these 4 points? Maybe I'll give you guys 20 minutes for you guys to complete these 4 points, complete with the auditor's approach. Okay, I think 20 minutes should be more than enough. Okay, so basically I'll see you guys at 8:45. I'll send the link for the Padlet in the Zoom chat. Okay, so these 4 points, firstly on warranty provision, on the delivery of the machine, the rights issue, and the local legislation. Okay, see you guys. Hi guys. Okay, time is up. Now it's 8:40. Just submit your answers to the Padlet. Okay, also I've actually sent you guys at the Zoom meeting chat the past year questions for June 2021, which is the next question on audit risk that we will be doing. Okay, so if you guys who are watching this video recording later on, you guys can actually access this through the Timba Flex one under the PYQ folder. Okay, just look for past year question June 2021. Okay, so let me just share my screen and then we can look through your answers before we move on to the next question. Okay, so let's look at Ain's answer first. Okay, the company contracted to purchase new machinery costing 2.4 million. Okay, is now scheduled. Hardco should not recognize the machinery costing 2.4 million as PPE, instead should be recognized as prepayment. According to IAS 16, PPE should be recognized when company receives the asset. Okay, I want you guys to be more accurate here. Okay, when you're saying it's actually not when the company receives the asset, but when the rights and rewards have been transferred to the company. Okay, basically the PPE should be recognized in accordance to IAS 16. Okay, you can either say PPE should be recognized when the rights and rewards over the PPE have been transferred to the buyer, or when the buyer actually obtains control over this asset. Okay, so this is something that you can fix in this answer. Maybe just let me fix it out, okay? PPE should be recognized when the risk and reward have been transferred to the customer. Okay, and then maybe you can say, i.e. when the machine has been received in October. Okay, we are applying to the scenario. So there is a risk of PPE account being overstated and the prepayment account being understated. Okay, so this is one mark here. Co made a rights issue, okay, therefore requires to be split into share capital and share premium. Okay, this is correct. There is a risk ordinary share and share premium being misstated. Yeah, this is one mark. Okay, and maybe you can also include on the fact that insufficient disclosure on the rights issue. Next, Hardco's directors correctly disclose the remuneration. The impact still cannot be fully determined and measured. There is a risk that the FS may contain due to the breach of local legislation. I would say the issue right now is that they are not providing sufficient disclosure. So I would say that if we breach local legislation, this can actually lead to fines. Okay, that is an implication that you can see. The explanation is basically something like whenever, okay, I'll show you guys my answer but after this, but basically whenever the local legislation requires more extensive disclosure, in this case, we basically have to follow the requirements of the local legislation. Okay, local legislation actually takes priority over IFRS punya standards requirement. Okay, so that is more or less of the explanation. For the implication, we can talk about the possibility of penalties or something like that. Okay, so this last point, maybe I can just give a 0.5 marks. Okay, but that's a good attempt. Thank you for posting your answers. I think that this all requires effort. Okay, guys, I'm really grateful for you guys can actually submit your answers. Maybe after this, I'll try to take my time to slowly go through your answers one by one. Okay, let's look into Iman's answer. Okay. I want to save this to file, but I don't know how to. Okay, so the first point, okay, the warranty provision reduced from 6%. Okay, IAS 37 requires that provision should be recognized when there is a liability, which present obligation resulting from past events. Okay. Alright. Okay, right now, the issue is more or less on, we have to explain on what is the issue right now. The issue right now is not that they are not creating a provision. Basically, they are not creating sufficient provision. The issue is that they have reduced this provision. So, and this is actually an uncertain amount. Okay, so the issue is basically that the provision may be understated. So your last point here, the provision may be understated, is correct, but the explanation feels like you're not really like explaining the actual issue at hand right now. Okay, I'll show you a way for you to improve this later on. Okay. Okay, another thing that you should obtain a breakdown of the provision. You cannot just obtain a breakdown and not do anything about it. Okay, what will we do for this breakdown? What can we do after we look at this breakdown? Can you guys just give some suggestions? Maybe what can we do? Okay, what can we do? What is our auditor's response in relation to this provision? If we want to obtain the breakdown, what will we do next with this breakdown of provision? Any suggestions? Okay, so maybe what we can do is we can recalculate. Okay, and maybe said review the supporting documentations. Yeah, we can look into the supporting documentations. Another thing is that we can basically look into the prior year of new claims. Okay, because we want to assess the reasonableness of them reducing this warranty provision from 6 to 2%. Okay, so the next point is hardcore recognize 0.6. Okay, so this is correct. If 0.6 million of the expenditure are wrongly expensed off, there is a risk that expenses will be overstated. Okay, intangible assets and profits will be understated. Okay, I think this is correct too, I guess. Usually it's the other way around. Usually they will not usually they will wrongly capitalize the research expenditure even if they do not meet the capitalization criteria. But your answer is still correct. It's just the other way around. Usually it's more likely for the companies to overstate the intangible assets. So instead of them wrongly expensing it off, they will usually wrongly capitalize it. Okay? Because they would want to overstate their assets and understate their expenses. So I would say terbalik sikit, but I can still give this point 1 mark. Okay, the delivery of the new machine is delayed and is now scheduled to be delivered in October. Okay, so opportunity cost and idle time may occur as the new machine is being delayed. Okay, so this is try to bring in what is the accounting standards punya requirement. Okay, because sometimes if we're not sure we basically akan like kind of bantai. I get that, but try to base your audit risk punya answers to what are the accounting standards. So when we're talking about a machine, this should fall under IAS 16 PPE. Okay, so we want to talk about what is IAS 16 punya requirements. Okay, so this is not related sangat this opportunity cost and idle time. Okay, so this last point here is correct. There's a risk that the right issue is not being split correctly and there is a classification error. Okay, so this is 1 mark. Okay, confirm whether the amount of rights issues has been received. Okay, so the first point is correct. We calculate split between ordinary share capital and share premium. Okay, I think that the first and the third point is the same, it's repetitive. So the first point is actually okay. The second point is confirm whether the amount of rights issues has been received. This I want to say that it's not complete. How can you guys make this point complete? How can we confirm whether the amount of right issue has actually been received? Okay. So basically, Azim cakap cash received. Okay, what can we actually look into? We can look into the cash receipts within the cash book or the bank statement. Okay. So here you talked about the purpose. Basically, the purpose is we want to confirm whether the amount of rights issue has been received, but you did not talk like how are we going to confirm this? Okay, we can confirm this by reviewing the cash receipts within the cash book and the bank statement. Okay, but thank you for attempting. I hope that you also included the benefits of audit planning. Okay, for the other points though, I usually will not touch that much because I feel like our focus is more on the audit risk apa semua. Okay, but maybe you guys can try to attempt it yourself. Okay, so moving on. So maybe I'll just take one more before we go on to the next question. Okay, I'll look into Najwa's answer. Okay. There is a risk can only be recognized the advance payment when the machinery is received. There is a risk that Hardcore recorded the advance payment as a purchase. They would not recognize it as a purchase. Basically, they would recognize it as a PPE. So this will result in asset being overstated. So this statement here is wrong. There's a risk that Hardcore recorded the advance payment as a purchase. Okay. How you can correct this is basically there is a risk that Hardcore recorded the advance payment as a PPE. Instead of, you have to talk about the correct treatment also. Instead of a prepayment. This should be recognized as a prepayment, right? Because it is an advance payment. Okay, this will result in asset being overstated. Okay, recommendation, inquire the management if the machinery has been received. If it isn't received, review if there is any prepayment made on the advance payment. Technically, this advance payment is the prepayment actually. So what is the recommendation is actually we want to review whether the company is actually accounting for this as a prepayment or not. Okay? And our issue right now, the risk is that Hardcore recorded the advance payment as a PPE instead of a prepayment. So what kind of document can we look into? Okay, when we are reviewing the PPE, what document or what record are we going to look into when we are thinking of PPE? So yeah, Ahmad said asset register. Okay, so we are basically going to look into the NCAR, which is the non-current asset register, and we want to confirm, did they actually wrongly capitalize this as PPE? Okay, if this was wrongly capitalized as PPE, this will be shown on their non-current asset register. Okay, so whenever you guys think of the auditor's approach, try to think of what is the document that we can look into. Okay, review, local legislation require more, okay, on the remuneration as they are not intended to provide. There's a risk that Hardcore may not follow the local legislation. Review the breakdown on the director's remuneration and ensure that it follows the local legislation. Okay, right now, I feel like in this point here, the issue is on the disclosure, but you guys are not highlighting on the disclosure. You guys are like talking about something else. Okay, right now, we have to focus our attention more on the disclosure part. Okay, so I'll just like give you guys a little sample of how I did my answer in the most simple way. Okay, hold on. Alamak. This is my incomplete answer. Sekejap, Okay. Okay, so this is my answer. Okay, this is on the warranty provision. As per IAS 37, a warranty provision should be recognized. And we talk about how this warranty provision calculation is something that requires judgment, as it is an estimate of uncertain amount. Okay, so there is a risk that the warranty provision could be understated, leading to understated expenses and liabilities. So whenever the management says something, okay, even in this case, let me open the question again. Okay, the FD said that the FD has made this change despite no significant difference in construction techniques or the level of claims in the year. So whenever the FD or the management says something, in the auditor's approach, we want to question this. Okay, we want to discuss on this. All right, so right now, my answer is basically we want to discuss with the management on the basis. Okay, don't stop there. We want to apply to the scenario. We want to discuss with the management on the basis and the justification for the reduction from 6% to 2%. Okay, so talk about this reduction. This is how you apply to the scenario. And again, what is the purpose? We want to assess the reasonableness. Okay, and basically the other point is we want to look into the prior year provision and compare this with the actual level of claims in the year to assess the reasonableness. Okay, so these points is something that is repetitive juga. Okay, there's going to be another question that asks you guys on warranty provision. So I hope that you guys can take note on this. Okay, you want to compare the prior year provision that is being made and the actual level of claims. Okay, maybe last year they provided for 6%, and maybe the reason why they reduced this to 2% is because the actual level of claims by customer in the previous year was not that much. That's why they actually reduced this. So that's why we want to compare this to assess whether is it reasonable or not. Okay, so yeah, this is a very repetitive point, right? Only development costs should be capitalized if they meet the capitalization criteria. Okay, so this is also another thing I forgot to repeat just now. We will obtain a breakdown and supporting documents. Okay, so just now I talked about obtaining the breakdown and assessing whether they meet the criteria. But another thing that's very important, it comes as a set. Okay, we have to get the breakdown, the supporting documents, and lastly, we want to assess whether they are meeting the criteria correctly or not. Okay, so these are 3 points in one. Okay, so this is basically my answer. Remember, I basically repeated this thing. Okay, obtain a breakdown of the research expenditure recognized and the development cost capitalized. The first point, I'm relating it immediately to the scenario. Review the supporting documentation. Okay, and basically, the purpose is for us to see whether they meet the capitalization criteria as per the IAS 38, which is on intangible asset, right? Lastly, we discuss the accounting treatment with the FD to ensure it is in accordance with IAS 38. Okay, so again, just now, on the machinery, this is the correct sentence actually. Okay, the machinery should be capitalized once the rights and responsibilities of over the asset have been transferred, which is when the machinery is delivered. Thus, the 1 million should be recognized as a prepayment. So in this case, if the deposit has been wrongly capitalized, PPE may be overstated and prepayment may be understated. So here, like you guys said, we will review the NCAR. Okay, review the NCAR. Why are we doing this? To determine if the 1 million deposit had been capitalized. Okay, if it has been capitalized, it will be reflected in the NCAR, and then basically we will have to advise the management on what is the correct accounting treatment. Okay, and we have to finally confirm that this has been recognized as a prepayment. Okay, so it counts as a set juga. We want to review whether this has been capitalized. If it has wrongly been capitalized, we will basically discuss this. Okay, we will discuss the correct accounting treatment, and we don't stop there. We will have to check, confirm whether did the management correct this or not. Okay, basically have they recognize it as a prepayment, and what is the correcting journal entry. Okay, so for example, previously, let's say they debited PPE, right, for this amount. So they have wrongly capitalized it as PPE. So the correcting general, we will basically look into the correcting general entry where we will instead debit prepayment and credit out this PPE. Okay, that's what it means. Okay, guys? All right, so on the rights issue, I think you guys have kind of understand how to answer it already. Okay, on the last point here, okay, like I said, whenever the local legislation overrides the IFRS standard, the company must comply with local legislation. This is basically the explanation. If the disclosure is incomplete, basically, we're just saying that the director's remuneration disclosure will be incomplete if they are not providing additional information. So they may be liable to penalties. Okay, so we want to discuss with management and review the requirements of the local legislation to determine if the disclosure is included appropriately or not. Okay, so far so good, guys. Okay, so let's move on to the next question. All right, can you guys open, I've actually sent it to you guys just now, on June 2020 ke June 2021, yeah. June 2021. Let me just open the question. Okay, so this is the question. This is on Corley Appliances Co.